studying your last two. I swim med when they turned in. The staring down to mute and can learn the pole that sunk he died.
In this slide, we'll introduce Form T1135, officially called the Foreign Income Verification Statement. Despite its name, T1135 is not a tax calculation form. It is an information reporting form that tells the Canada Revenue Agency, or CRA, about certain foreign property owned by Canadian taxpayers. Many beginners assume that filing a T1135 means paying additional tax. That is not correct. The purpose of the form is simply to disclose specified foreign property so that the CRA has visibility into foreign investments held by Canadian residents. The diagram in the center illustrates this process. A Canadian corporation may own investments or property in different parts of the world, such as the United States, the United Kingdom, Europe, India, Australia, or Japan. Instead of reporting each country separately to different tax authorities, the corporation reports its specified foreign property to the CRA by filing Form T1135. So, who is required to file this form? Generally, Canadian tax residents including corporations, individuals, and certain partnerships must file T1135 if they own specified foreign property with a total cost amount of more than 100,000 Canadian dollars at any time during the year. Notice that the rule refers to the cost amount, not the current market value. Even if the investments have increased or decreased in value, the filing threshold is based on their original cost amount, as determined under the tax rules. The gauge on the right summarizes this requirement. If the total cost amount of specified foreign property is 100,000 Canadian dollars or less, a T1135 is generally not required. If the cost amount exceeds $100,000 at any time during the year, a T1135 filing is generally required. The comparison table at the bottom highlights another important distinction. A regular tax return is used to calculate taxable income and determine how much tax is payable. Form T1135 does neither. It is simply an information return used to report foreign property to the CRA. The key takeaway is this: T1135 reports foreign property, not foreign tax. Its purpose is to improve transparency and help the CRA verify that Canadian taxpayers are properly reporting income earned from specified foreign property around the world. Now that we understand what T1135 is and when it must be filed, let's look at the types of foreign property that need to be reported. The key term to remember is specified foreign property. This refers to certain investments and assets located outside Canada that are owned by a Canadian taxpayer. Some of the most common examples include foreign bank accounts, foreign shares and securities, rental properties located outside Canada, foreign mutual funds, and foreign brokerage accounts. If these assets meet the reporting requirements and the total cost amount exceeds the filing threshold, they are generally reported on Form T1135. However, not every foreign asset is reported. The panel on the right highlights several common examples that are generally not reported on T1135. These include a vacation home that is used primarily for personal enjoyment, personal vehicles, jewelry and other personal use property, Canadian real estate, and ordinary household goods. These assets are generally outside the scope of the specified foreign property reporting rules. The clipboard in the center summarizes the overall idea. If an asset qualifies as specified foreign property, Information about that asset is reported on Form T1135 and submitted to the Canada Revenue Agency. Now let's look at the example shown at the bottom of the slide. Suppose a Canadian corporation owns U.S. stocks with a cost amount of $70,000 and also has a bank account in the United Kingdom with a cost amount of $40,000. Together, the total cost amount of the corporation's specified foreign property is 110,000 Canadian dollars. Because the total cost amount exceeds $100,000 at some point during the year, the corporation is generally required to file Form T1135. Notice that we are using the cost amount, not the current market value. Even if the investments have appreciated or declined in value, the reporting threshold is based on their tax cost amount under the Income Tax Act. The most important lesson from this slide is that T1135 is based on the total cost amount of all specified foreign property, not on each asset individually. Always add together the cost amounts of all reportable foreign assets before deciding whether the $100,000 filing threshold has been exceeded. A simple way to remember this is: identify the specified foreign property, calculate the total cost amount, compare it with the $100,000 threshold, and then determine whether a T1135 filing is required. In this final slide, let's see how Form T1135 fits into the overall corporate tax compliance process. The process begins when a Canadian corporation owns specified foreign property. This may include foreign bank accounts, foreign investments, rental properties located outside Canada, or other qualifying foreign assets. The first step is to identify all of the corporation's specified foreign property. Once those assets have been identified, the corporation must determine the cost amount of each asset. Remember, T1135 reporting is based on the cost amount under the Income Tax Act, not the current market value. After calculating the total cost amount, the corporation prepares Form T1135 by reporting the required information for each specified foreign property. This includes details about the assets, their location, and their cost amount. The completed T1135 is then filed together with the corporation's T2 corporate tax return. Although it is filed alongside the tax return, it serves a completely different purpose. The T2 return calculates taxable income and corporate tax, while T1135 simply provides information about foreign property owned by the corporation. Once the form is filed, the Canada Revenue Agency may review the information as part of its normal compliance activities. The CRA uses this information to verify that foreign income and foreign assets are being reported correctly. The panel on the left highlights why T1135 is important. It promotes transparency by giving the CRA visibility into foreign property owned by Canadian taxpayers. It supports tax compliance, encourages accurate reporting, and helps corporations maintain proper records of their foreign investments. The panel on the right explains why filing is equally important. If a required T1135 is not filed on time, the corporation may be subject to late filing penalties. Failure to report required foreign property can also result in additional penalties, increased CRA scrutiny, and extra compliance costs. Maintaining accurate records throughout the year makes preparing the form much easier and helps reduce the risk of reporting errors. The timeline at the bottom summarizes the complete process. First, the corporation acquires foreign property. Next, it tracks the cost amount of each asset. Then it prepares Form T1135, files it with the T2 return, and finally maintains supporting records for future reference. The key takeaway is this: T1135 is a disclosure form, not a tax calculation form. Its purpose is to inform the CRA about specified foreign property owned by Canadian taxpayers, helping ensure transparency and compliance with Canada's international tax reporting requirements.